Welcome everyone to July 6th. It is our All Access Belize, and I am excited about this month's edition as we have my CPA, and he's a tax professional. He has Mike Pine and Company, and I'll let him introduce himself in a second. And also want to congratulate him for being a new father. So he is probably a little tired, but he is uh, he is a great guy. I've heard him speak at many events, and he does a lot of international tax accounting, and he does a lot of syndication or group investing taxes. So he's the one, if you're investing in any of my syndications, my group investments, he is the one that's doing the K1s and advising on the tax questions and things like that. So I invite you to please put any question and answers in the question and answer box. And I'll probably have Serena, kind of come on and read it because I cannot read it and do everything from my phone. So, welcome, Mike. How are you doing today, sir?
I am very well, very happy to be here. I just wish I was somewhere like that blurry background that you have down in Belize, David, but very happy to be here. Thank you for having me.
Well, we're trying to get you down here for sure. So, tell us a little bit about Mike Pine and Mike Pine Company, kind of what you do, where you're located, and a little bit about yourself.
I will give you an abbreviated version because I think we only have an hour tonight. Otherwise, I could go for a few hours. According to my wife, I love to talk about myself too much, but about a little over 23 years ago, I started my career as a CPA with PricewaterhouseCoopers. They're pretty big, I think the biggest CPA firm in their venture capital and private equity group out in the Silicon Valley. And that was right before the dot-com bubble burst. And I got to spend two really awesome, fun years while the bubble was continuing to grow, working with some of the largest private equity and venture capital groups in the world. It was a lot of fun, and that's where I learned partnership tax, taxation of syndications, and that was a lot of fun. But I never really got to see what happened to the investors who got these really cool, very tax optimized K1s. Never got to see how much tax they were actually going to get to save because we were just doing the big $1 billion funds. And ultimately, it was their CPAs taking their K1s, putting in their tax returns that got to decide whether they were taking advantage of any of our cool tax optimization strategies we did at the partnership level. So after about 6 years of that big firm, I went to a smaller, more regional firm here in Dallas, Texas, and got to see how most CPAs don't handle the cool tax optimization techniques that are done on big venture capital or even any investment partnership. And they tend to miss a lot of the cool things they could take advantage of on the actual investor's tax returns. So I've spent the last 14 years of my career really honing in on how do we take advantage, because there's a lot of tax advantages in alternative investments. How do we take advantage of those to help people grow their net worth, to grow their investment portfolio without paying too much in tax? Ultimately, we all should pay every dollar in tax here in America that we're legally obligated to pay. But in my experience of all our new clients, 9 out of 10 have paid more in taxes than they should have. And some of them have come back to me after I explain that to them and they tell me, well, I just don't want to get in any trouble. I want to make sure I'm on the up and up with the IRS. Most people who get audited in the United States result with having zero changes made on their tax return by the IRS. So people telling me, well, I want to pay more in taxes so the IRS doesn't mess with me, that doesn't wash, because most people that get audited aren't told that they're not paying enough in taxes. They're actually paying too much, and for some reason they want to tip the government. And There's been times in my life and times in our country's history where I think the government deserves a little extra tip here and there. But quite honestly, I don't think that's being a good steward of your money and the money that you're put in charge of by tipping the government, who tends to waste it, in my opinion. And I won't get into politics, but I do think the money that we pay in taxes tends to get flushed down the toilet, and I'd much rather it go to work for the economy and to grow the economy and grow our financial freedom. So that's kind of my mission in life, is helping people who learn to invest with people like you, David, who know how to make money. I know how to count it and save taxes. You know how to make money. Helping people who invest with people like you, or people like you, David, to keep more of their hard-earned money so that they can continue to grow and snowball the economy. That's my mission in life, and that's what we do. We have a firm now of 21 people. I have 3 future partner sons, the most recent one born last week, and 2 others that are a little bit older. And hopefully, in a perfect world, I'd love for them to choose to be as enamored with taxation as I am, because there's so much cool stuff you can do with it, and it can really add a huge snowballing component or exponentially growing component to your portfolio based on the time value of money. If you can have your earnings grow, get high ROI from investments you make, and not have to pay so much early on to the tax man.
Yeah.
That's my elevator speech, David. How'd I do?
I agree. I agree. And there's not too many people I know that have read the tax code. But I do know of 2. One is Tom Wheelwright, and I do believe you have read it yourself, right?
Multiple times.
Yeah, exactly.
Probably as many times as I've read the Bible. Yes.
Yeah. So tell me, how big is the tax code?
Depends what you consider the tax code. As a CPA, I consider the Internal Revenue Code, or the IRC. That's the law that Congress has passed and the president has signed into law. That's the Internal Revenue Code. That's the basics. And that's almost 80,000 pages based on the books the government actually publishes. Depending on how big the pages are, it could be more, it could be less. But that's only part of it. It's funny, the Congress writes this law, president passes it, and they say, this is the tax law. But none of it makes any sense. So they give the Treasury Department the authority to write Treasury regulations that interprets their tax law and say, this is how you're supposed to follow that tax law. That in itself is many tens of thousands of pages more. So when you combine those, you're talking well over 100, maybe even close to 200,000 pages. But it doesn't stop there, David. So you've got Congress writes the law, Treasury Department, huge department that runs the IRS and a bunch of other stuff. They come up with, hey, this is what the law is supposed to be. This is how we think you should interpret it, but no one still understands how to interpret it. So then you have case law, tax court case law, mostly in tax court, but there's some federal regular courts that also weigh in on tax law. Those are hundreds and hundreds of thousands of pages. And my last count I looked at, and I don't know if this guy's right, but he counted up the pages and he said it's over 1.3 million pages if you consider all those authorities put together. All 3 of those are the major hierarchy of tax law and what we need to follow, and those are changing. And I don't know, and I'm certainly not a CPA that knows it all. I've picked a couple niche areas that I love and can focus on and get really good at. I don't know any CPA that can learn it all. It's too much.
Right.
It's certainly too much for a normal business owner, a normal employee that's doing their best to serve their employer or serve their job or serve their company and focus all their efforts on that. There's not nearly enough time to go out and read 1,000,000+ pages of documents to figure out, am I paying too much in taxes or not? So
Right.
it's also a very secure job I have, thankfully, to
Yeah,
the
for
government.
sure. Now, isn't the tax code is a bunch of ways to save taxes? There's only a certain amount of laws, but the majority of it is how we can save taxes. Can you touch a little bit on that, and then we'll kind of get into how it applies to you, myself, Dave, and those listening to this this webinar?
Yeah, you bet. So Tom Wheelwright said this, and I read this in one of his books 20 years ago, and since I've learned the tax law as much as I have, I agree he's right. I think he actually underestimated, but he said 99.5% of all of what we consider the tax code, and he was just considering the Internal Revenue Code and the Treasury regulations. 99.5% of that has nothing to do with levying the taxes, nothing to do with assessing taxes. Only less than 0.5% deals with, hey, you make this kind of money, you pay this percentage in tax, and this is how you figure it out. All of the rest of the tax code, that 99.5+%, offers incentives, things that our Congress, our society has gotten together and says, this is what our economy needs. This is what's good for our national security. This is what's good for affordable housing. This is what's good for affordable healthcare. Let's offer these incentives in our tax law so that we can help raise the tide so all boats can be lifted. And Wheelwright's right. I think it's closer to 99.7% of the tax code offers incentives, and less than 0.3% deals with the levying of taxes, but most of it offers incentives. And when you think about that, again, when I talk to my normal average new client, again, they say, I don't want to be too aggressive with my taxes. I want to pay my fair share, maybe pay a little bit more to keep the tax man happy. And my response to them is, these incentives in the tax code, this is what our society, our Congress got together and decided this is what's best for our country. If you take advantage of these incentives, it will do what our country needs you to do. And I don't say this lightly. I really believe this, David. It is as Americans, and I don't know how many people we have on here that might not be an American, but as an American, it is our patriotic duty to our country to follow these rules, to utilize these incentives to help grow our economy. And it so happens that the way incentives work is you get something by giving something. Hopefully you get a little bit more than what you give. And that's exactly what we do with our clients on taxes, and what you've learned to do so well, David.
Exactly. And so basically, putting that in layman's terms, the government knows we need housing. The government knows we need alternative or energy. So they give credits or incentives for those to build houses, to put solar on their property, and they give, credits and things like that. And so what we're doing, or what we're saying, is it doesn't matter which, if you're Republican, Democrat, or whatever, they all have their agendas, and they will all put incentives in place for you and I to be aware of, where we can invest our money and get a portion of it back, which means we can invest in it more.
Absolutely.
And so if you're listening tonight, or you're listening to the recording, this is All Access Belize. And so we like to bring it, kind of home. And if tonight we're talking about an American citizen. We've had other tax professionals on that were in Canada. But, we're talking about American citizens. If you invest in something worldwide and you are using it for income, you can write those off. And again, Mike, correct me if I'm wrong. You can write off the expenses. You can write off, and you have to declare the income. So that's kind of what we're going to be talking about the rest of today. And again, please throw in some question and answers. And we have Dave Santilli. I don't know, Serena, if you can put him as a co-host, and maybe he has the bandwidth or not. He's in Mexico right now, taking a little vacation. And so he is, as you know, my partner in the Finca Chocolat farm in PG, where we have the 515 acres. It's the largest chocolate farm or cacao farm in the country of Belize at this time. And we have many other crops on there. And so, Dave, how are you doing, sir?
I'm doing great. And actually, I do have the bandwidth here, unlike when I'm on the farm out in the middle of the trees. But someone has disabled my video, but I don't think everyone needs to see what I look like unless you want to enable it. I'm doing well. Glad to be here. Thank you for having me.
Good, good, good. So, I think we have a couple questions that we'll look at. I think I can. Okay, so we do have Dev. How are you doing, buddy? He's asking about the depreciation schedule for like a $25,000 investment. So he's talking about the chocolate farm. If he invests $25,000, and we kind of had this conversation today, can you kind of talk a little bit about that, Mike? How does that pan out for an American citizen investing $25,000 in this chocolate farm? How is he able to depreciate, and what can he depreciate, and things like that?
Yeah, you bet. Let me first bring it back to what you were mentioning earlier about the specific incentives that the American Congress has gotten together and say, this is what our country needs. There are incentives that they've come up with that said, you know what, we need sustainable farming. We need to be able to predictably and reliably source different crops into this nation to keep it secure, including, I can't say the way you guys say cocoa. I'm just going to stick with cocoa. Forgive me, everyone. I know that's not the right way to say it, but I'm Southern. Give me
Just
some
say chocolate.
chocolate.
Cocoa
So
works.
chocolate or cocoa, that also offers some incentives. The IRS says a chocolate tree that's not located in the 50 states proper, it has a 20-year useful life. So whatever the cost of that tree is, we're going to let you depreciate that over 20 years if it's not in which most chocolate isn't, if it's not in one of the 50 states. Territories don't count. Belize and Puerto Rico are taxed the same way as far as depreciable property. So I've got a schedule that we computed today for this webinar. And I apologize, Dev, I know you're asking about $25,000. I have it broken down into $20,000 units. So whatever my answer is, please divide by 4, multiply by 5, and that's your answer. But the way they've got this set up and this particular investment set up, and under their incredibly conservative approach, that doesn't include the ROI they're probably going to earn, but under a conservative, slow approach for over 10 years, if this is your only passive investment, all of your distributions are going to be tax-free because of the depreciation. There's a lot of stuff besides trees on the farm. They've got equipment, they've got a farmhouse, they've got fencing. There's other stuff that can be depreciated, but the big depreciation is from all the investment in the trees, not just the cocoa trees, but the other trees I'll let them talk about, and the hardwood timber that ultimately gives you a large ROI very late on in the investment. But again, so for a $20,000 unit based on additional 15,000 trees being planted each year, you're looking in the first 10 years of depreciation. Let me just add these up. On $20,000 of $1,200 of depreciation that you're going to get. That's just on the trees. It's not counting the equipment. Now, if you have other passive investments, Dev, you don't have to only utilize this depreciation offset income from the cocoa farm, the chocolate farm. Sorry, Dave's. From the chocolate farm. You can use this depreciation in year 1 to offset other passive investments you have, as long as you and your tax accountant know what to do and aggregate your passive investments. But what I liked when I was running these scenarios prior to this webinar is the fact that you'll be getting cash distributions starting in year 1. I'll let you guys talk about it when the first distribution comes out. Those cash distributions are going to be tax-free. If you don't have other passive investments that you're using the depreciation for, those distributions are going to be tax-free for 10 years, potentially more, potentially less if they make too much money for you. But you've got tax-free distributions. Let me alternately, if you take the same 20,000 or 25,000 in your case, Deb, and invest it in a dividend paying stock on the stock exchange in Wall Street, every dollar of dividend you receive as a distribution, you're going to pay tax on all of it. Depends, I don't know what your tax rate is, but you're going to pay your tax rate on every dividend distribution you get. If you were to only invest in this one investment, and they perform on the very conservative estimate, then you aren't going to pay taxes on your first 10 years of distribution. Consider the tax savings that you're going to have year 1, year 2, all the way through year 10. If you take that money and reinvest it in something else, whatever you get on that reinvestment of your tax savings, that's going to give you a lifetime difference in earnings that helps snowball your investment portfolio much more so than if you invest in some normal, non-alternative taxable investment that's going to pay out guaranteed taxable dividends or distributions. Dev, feel free to speak up if you like, or raise your hand again. I assume we can unmute him if that doesn't answer your question, or if you have any follow-ups on that.
Yeah, and again, I'm not the smartest guy in the room, but I know smart people. And so that's why we call on Mike Pine, and that's why he's doing our taxes. So those of you that invest with, Finca Chocolat, we use Mike, and his company will be furnishing the K1s that you'll be getting. And so every year, before Mike does the K1s, we'll be giving him a list of everything we're putting into the farm, so far, because every year we're putting in more trees, we're going to put in, more drying, more fermenting and things like that. And all that will be able to be depreciated. So go ahead, Dev, you had another question.
So right now, as far as the passive income goes, so I'm investing in single family rentals. So just to take that example, say I put 20,000 down for 100,000 property, 20% down. I have appreciation because the property appreciates every year. I have depreciation that I can deduct my income, whatever income I am generating from the cash flow. Plus, I have expenses for property management and repairs and all those, and interest that I pay. So I have a lot more deductions with the single family rental. So I'm comparing that to this investment. I'm putting $20,000 for a single family rental. It gives me appreciation benefit, depreciation benefit, tax incentives, all the and somebody's paying my mortgage.
Mm-hmm.
I'm comparing that investment to this investment. I'm putting 20,000 or 25,000 investment. What benefits I have compared to that?
Similar but different. Like, I don't want to compare apples to oranges. This is a very different type of investment. They're both alternative investments. They're both hard assets. You're not relying on some stock certificate to say that you own something. I mean, there's an actual asset out there that you own. The actual year one depreciation under current tax law is going to be more for your single family house than it would be for a farm in Belize, because you're not eligible for bonus depreciation for anything outside of the 50 US states plus the District of Columbia. However, you're also, I would consider, do you want all of your eggs in one asset class like real estate? You might, and if you're very comfortable with that, go for it. But I do believe in diversification. That's my opinion. I'm not an investment advisor. I'm just a tax guy who loves tax. But this is something, if you look at the whole pro forma on a long-term basis and look at their schedule of pro forma distributions and compare that to a pro forma for the same period of time, and I would say go out at least 10 years, maybe even 20 years for your single family housing, you're going to see some pretty major differences. They also have operating expenses, which would be a tax deduction for you, just like your operating expenses or your management fee expenses that you have on your single family housing. They have some of those, but that comes out before your distribution. Whereas if the management company for one of your single family residences has a big capex in 1 month or a big repair in 1 month, suddenly you got to send them money. You're not getting a distribution. I'm not saying that can't happen. I'll let both David and David talk about that for this investment, but their distributions are based on after already having paid all of the operating expenses, including after having planted all the additional trees which are continuing to grow your revenue. So, Dev, the truth is you're not going to get the same amount of depreciation in year one that you're going to get at a single family house, while we still have the bonus depreciation regime that I hope will be extended in the very near future in our country. But if you chart it out on pro formas over the next 10, 20, 25 years, then compare the two. you might see a very big difference. On your single family housing as well, you're going to run, I don't know if you're doing cost segregations or not. If you're doing cost segregations, you're using up all your depreciation, not all of it, but a good portion of it in the first year. This has depreciation, continuing new depreciation from new asset purchases every year for the next 20 years. So there's also that difference. Your tax advantages, your tax write-offs, unless you have a bunch of repairs in year 7 or year 8 of your single family housing, they're going to run out. And eventually you're just paying taxable income unless you go buy more assets and start depreciating them as well. This asset class seems to have, it does have, based on the pro formas I'm looking at, deductible expenses almost to the end of the asset life of this asset. In the end, you're going to pay taxes because they're making too much money in years 20 through 25. But maybe at that point, you can go buy another single family house.
So I am definitely looking into this investment because I want to diversify, like you said. The reason I am looking into this is I'm comfortable with single family rentals, and my CPA, he's just depreciating for the next 27.5 years, and I like it. Just keep it that way. I buy one property every year, so I'm comfortable with that. So I'll keep doing that, but I'm also looking for diversifying into another investment, and I like this investment because it's long term and it's like legacy investment. So, and the reason I'm looking into this one is I now started another business for wholesaling properties, where my accountant said that this is ordinary income, so it's taxed 30%. So last year I had to pay 30%. So he said, you better start looking for somewhere where you get a depreciation on the very first year because you are generating a lot of income. So single family was not generating that much income. It was just like 400-500 positive cash flow from each property. So he was able to easily adjust that um, with all my deductions. But for my wholesale, it's a assignment fee for every deal. It's a big check, and it's considered ordinary income. I had to pay 30% tax last year, and he saw that. So that's why he advised me to look into other investments that can give me depreciation. So that's why I asked that question. So what do you think? Will this investment uh, uh, supply
Yeah.
that I'm looking for?
No, if I understand the question right, what your accounting is saying is your development or your wholesale fees, commissions, whatever you call them, those are considered active income to you and ordinary tax rates. There's 3, and David, please stop me if I'm going in too much tax detail, but the IRS requires us all in the states to track and report your income in 3 separate buckets. One is our active income bucket, and that's normally business income, commission income, W-2 income, pension distributions. That's called your active income bucket. You can't use stuff from your passive income bucket, which I'll get into in a minute, or your portfolio income bucket, like a bunch of capital losses, to offset your active income. You can use a little bit, but most of it basically you can't use. So it sounds like you have an active income problem. Your real estate, unless you're a real estate professional, Dev, your single family houses, those are considered passive income or passive losses if you're generating taxable losses. Any losses in that passive bucket can't be utilized to offset active income, except under a very rare circumstance. If you, let's say you have a bunch of passive losses from one house that you bought and it just sucked all your income out and had tons of capex that you weren't expecting, has a big loss, then you turn around and sell it. When you sell or dispose of a passive asset, that will release the losses to go offset active if you want, but then you're selling an investment for a loss. So that's not great financial planning, in my opinion. Decent tax planning, but not great financial planning. Then you also, on the third bucket, is your portfolio income. Those are your stocks, your bonds, bank interest. That's portfolio income. You have to track all those separate. You have to pay taxes on those separately. Sounds to me like you have active income from the wholesaling business. You need active deductions or active tax losses to be able to offset it. If you become a real estate professional on your
Which I am.
Oh, you are.
He said you are a real estate professional because you spend more time in wholesale activity.
Okay. I don't know all the details that you have, but let's assume he's right and you're a real estate professional. Then any investment in a real estate type activity could could potentially produce losses or tax deductions to offset your active income. Your single family residence could definitely do that. And if that's the case, you ought to talk to your CPA about maybe accelerating some depreciation with some of your single family houses using a cost segregation to get some large losses in the years that you have big commissions or fees that you've earned in the wholesaling. Um, this is a farming activity. It's farming operation in Belize, and this chocolate production is not going to be active for you because you're going to be a passive investor. You're not going to spend a lot of time working on it. That's the benefit, but it's considered a passive investment for you. So any of the depreciation or tax advantages you get are going to stay in your passive income loss bucket, not be able to be brought over to your active income problem. Or it's a good problem to have. You're making too much money and having to pay high tax, but it'd be a better problem to have if you could avoid the tax.
Okay.
So again, everyone, thank you if you're joining late. We're talking with Dave Santilli. He's the majority owner of Finca Chocolat. He's my partner in the chocolate farm. And Mike Pine, he is my CPA based out of Dallas, Texas, or the Dallas area. He's not in the DFW proper, I don't think, right? You're in
We're in the Fort Worth area. I prefer to align myself with Fort Worth. Dallas
Okay.
is a little crazy for me these days.
And so we're talking about investing overseas as a US citizen and what kind of tax benefits do you get for investing either outside the US or and specifically Belize, or we can even, like we're doing with Dev, answer any questions on taxes. And again, Serena will put his contact information. We do kind of outgrow our tax professional. And Mike is definitely one that you can grow into, and he can start, with anyone that is, just learning and things like that. And then you can grow with him. I definitely outgrew who I was with, and they were just, like a mom and pop place. And I don't know, what do you call them? Those, TurboTax places and things like that. And so this is totally different. This is to help you legally pay what you have to pay, but take all the deductions that you're legally allowed to pay less taxes. And so Serena put in the chat box, reach out to him and he can give you a consultation, or one of his people can. That's his website as well. And there's probably some good reading in the website, and his team can help you. And Mike, how far back, or can you go back? Let's say Dev does a cost segregation and he made a lot of money the last 2 years. Can he go back and amend those taxes and do a cost seg, or would it kind of go back on this year and just lump it all in this year?
Generally speaking, it depends, but generally speaking, he can go back 3 years. That's a statute of limitations. You can amend a tax return for 3 years. You can do a cost segregation 3 years prior. In some cases, that makes great sense. In some cases, it's better to do it going forward proactively or retroactively and have it apply to future tax years or the current tax year. The nice thing about depreciation and cost segregations is you generally have the option of what's most beneficial to you to take it. Again, generally speaking, there's so many different facts and circumstances with every taxpayer, with every asset held. I got to be careful when I say generally speaking, but it truly is generally speaking, he could go back 3 years.
Okay, very good. And also, Dave is a lot of knowledge. He's been in Belize a long time. He, owns several businesses here. He owns some property, multiple properties here. He was on our All Access Belize a few months ago. So we can also, talk to him about operations of the farm. And Dave, I had some nice pictures today. Why don't you kind of give a little update on what the guys are doing at the farm currently?
Sure. So this time of the year, the nursery is just finishing out growing the plants in the nursery. We've got 12,000 cacao trees that we have ready to go in the ground right now. We've added 3,000 rosewood trees to the inventory for this year that are in the nursery growing right now. They will go in the ground in September, October, November to get a little bit of a start before the dry season comes in. And we are receiving salmwood trees. We ordered 4,000 salmwood trees this year from, I'm sorry, 3,000 salmwood trees this year from one of our neighbors in southern Belize who's growing those for us in his nursery. And then we're bringing them down. So right now they are prepping to plant out as the rainy season has just started. They're also dividing and expanding the lemongrass that we have in the fields already. We're looking to ramp that up dramatically over 23 and 24. So then 2025, we can start distilling and selling the lemongrass oil as well.
Very
And then
good.
the ongoing continual work. We just finished the harvest about 2 weeks ago. So all of the harvesting, fermentation, and drying is done for the 2023 season.
Very good. Thank you very much. So we're happy to answer questions about that. And so Dev did had a question on a teak plantation. I don't see the question now. Let me see if I can go it. So does a teak plantation qualify for any tax incentives to protect the planet when it comes to climate change?
Probably. Sorry for that qualification. So the Inflation Reduction Act, in quote unquote, that was signed into law, I think, November 15th of last year. It offers this really cool but very nebulous and very underfigured out yet law that says anything you do to remove carbon from the environment can give you a tax credit. So we had a taxpayer, not one of my clients, but a taxpayer out in Washington filed a tax return, and they said, hey, I just planted 1,000 of these trees. Each tree takes out so many tons of CO2 per year. I'm going to base it on the formula provided in the new Internal Revenue Code. And I think it was like an $800,000 tax credit. And the IRS has processed it. They got the money, but we don't know if that's going to settle yet. The law has not been settled on how that works for actual organic, they call it organic carbon sequestration. We know it's going to exist. We don't know how it's going to be tested. There's nothing yet in the Treasury regulations, the part of the law that's supposed to explain how to follow Congress's law, on how it works for assets owned outside the United States. So I don't know if that would qualify yet or not. I think in the next year or so, there's a lot of people trying to get it. There's a lot of people being challenged by the IRS. Another year or so, we should see some pretty good guidance on that. So I think probably, Dev, I don't have a definitive answer for you, though, exactly how it would work, though.
And Dave, do you want to talk about kind of the people you've been talking to?
A little bit. Yeah, I'm actually super interested in that, Mike. So when you get some clarity on that, please reach out. I'm going to send you you've got my contact information already, but please reach out to David and myself. We have been talking with, actually, part of the reason I'm in Mexico right now is we've been talking with a firm called the Next 150 that is arranging or putting together projects for carbon credits in Latin America. And they want to do a project in Belize. So I've been talking with them about doing a project with Finca and as the kind of the mother farm, and then we'll bring in some of our neighbors to increase the acreage for additional carbon credits. But if we can, my understanding has been that no one's done it internationally yet, but obviously I don't follow this stuff as closely as you do. So if it's possible, let us know, because we've got all the numbers for carbon sequestration. We're making biochar using that. So our numbers are great, actually, for that.
Wow. Yeah,
I'll definitely follow.
And let me just make a point that there's two kinds of different carbon credits out there. There's one that's now part of the Inflation Reduction Act, or our tax law, where the federal government's actually giving you a credit. But then there's these corporate responsibility carbon sequestration credits that those are purchased and sold, and there's actually markets, third-party markets out there where people will buy those credits for you, and there's no absolute discernible value, but people are making a fortune off of selling these and trading these. So that's something outside of the federal tax law. What I'm referring to is what's in the newer tax law that's just barely 8 months old at this point.
Right. And what we're going after right now is the second of those two. Obviously, we're working with consolidators that are putting projects together and then selling the carbon credits. We haven't really talked about this much publicly because it's still in the works. But if we can get credits through the federal government, we're investors, that's even better and easier. We don't have to go find a buyer. They're just there.
Agreed. Well, the cool thing is, I believe, and so far it holds true, each carbon sequestration asset or property you own can qualify for both. So you can double dip on the corporate responsibility
Wow.
credits and the federal tax credits.
Wow.
So
Okay, we can
sometimes
end this call right now. This is all I needed to know. Thanks,
so,
Mike.
I tell you what's cool. Sometimes our government actually comes up with really good ideas that will help our country, help the environment, help the world, and help our pockets. So that's one of them I enjoyed about the Inflation Reduction Act.
So let me ask a question, Mike. So you got John Smith buys a fourplex here in Belize. What is he allowed to do? And so it sounds like it's based on their current tax situation, if they're a tax professional or not. But let's say they're not. Let's say they have a W-2 or they're self-employed.
Yeah.
What tax savings can they get?
So like in Dev's situation, he's apparently considered a real estate professional. And I shouldn't say apparently, he is, because the CPA told him so, and I doubt he would tell him if he wasn't. So he's a real estate professional. That means any real estate investment that he makes, that he actively participates in the management of, any tax deductions he can generate can offset as active income. If you are not a real estate professional and you invest in most other real estate ventures that you're participating in, unless you're a real estate professional, it's considered a passive activity. You can take all the deductions in the world you want on that activity, but it's only going to be able to impact your passive income bucket. For a lot of people, especially retirees, that's their entire bucket or 90% of their bucket. So that's great. But in one of the reasons that I fantasize, David, of owning a quadplex or some nice property down in Belize would be as a vacation rental. There's this loophole in our tax law that says any property that has an average lease length of 7 days or less that you're renting, it's not considered a real estate professional activity. It's a normal trade or business by default. Long story behind that, and the reason, the way the Congress and the IRS came up with those rules, I love how it ended up, but the fact is, if you have a vacation rental, it's not considered real estate professional activity. So then all you have to do is qualify for what the IRS calls as a material participant. Basically meaning, as long as you're actively involved in the management of the business, it's now not in the passive income bucket, but in your active income expense bucket. So let's say my dream comes true with you, David, and we find a place that I get to buy and go stay at for a couple of weeks a year and rent the rest of the year for 7 days or less. All the depreciation schedule from that property can go to offset my job, my firm's income on my tax return, and be pretty awesome. If I buy that place, I'm going to need to go check out my investment at least once a year, preferably twice a year, because it's an important investment. It's going to be a big investment for me, and I owe it to my fiduciary duty to my wife for our investments to go make sure our investment's going well, to make sure it's being upkept well, to understand the environment it's in. So I'm going to have to travel down there. Well, suddenly my travel is not just fun travel. It's not entertainment travel. It's business travel. It's an ordinary necessary expense for me to run my business. I get to expense that to the business, whether it's considered real estate professional activity or passive activity or an active activity. It is a business expense for that business. Anything I spend to improve that property is a business expense. So just because you enjoy your business and your job doesn't mean it's illegitimate. You should have a job that you love. So it offers so many great opportunities, and that's why it's one of my dreams to be down there with you, Dave.
Wow. Okay. So that's awesome. All right. So we have another question. Do we receive a K-1 with the expenses and depreciation to take it to our CPA to file with our taxes?
You would receive a K-1 with one net number. It's going to include actually two numbers, one taxable number, one not. Your K-1 is going to show you your net income or loss. And after depreciation, it should be a loss for a number of years. That your CPA just plugs into their software. 99% of the time, it's going to report right on your tax return. But that K-1 is also going to show you your cash distribution for this year. Let's just say year one, you get $2,000 in distributions and you have a $3,000 loss because of depreciation. because your taxable loss of $3,000, again, I made these numbers up, because your taxable loss of $3,000 is more than the distribution you received, that means your distribution was tax-free. Your CPA needs to track those distributions for a whole nother reason, but you're only paying tax on the net number of income or loss that's being allocated to you. If you have other passive investments, that net loss from the depreciation in the first number of years, it can be used, if your tax advisor knows how to aggregate them correctly on your tax return, it can be used to offset taxable income from other investments. But yeah, you'll receive a K-1 with all the applicable information you need for your CPA to file your tax return.
And so that, let's say, using your example, you have $1,000 left over in depreciation. Can you carry that over next year?
Absolutely. So in the scenario that we ran on y'all's pro forma, David, we, starting off in year one, let me pull this up real quick. I'm on the wrong tab. Starting in year one, you would actually have a big depreciation carry forward of, well, I say big, relatively large, of a few $100, and you actually start accumulating larger loss carry forwards, passive loss carry forwards, for the first, under the conservative scenario, for the first 9 years. So you would end up having a large carry forward loss that eventually gets eaten up by income. But yeah, you have more depreciation than you'll have income and distributions. And you get to carry that forward until you use it, or if you sold your interest for some reason, then it gets released and moves over to your active income bucket.
Okay, very good. And so, so technically we do have depreciation. We do have appreciation, because as the trees grow bigger and we start selling the units at a higher price, that's appreciation, correct?
Correct.
And so we also have, outside of the US, so outside the banking system, into a real asset. So this isn't a pitch for Finca Chocolat Investments, but just to kind of, just some of the highlights. And then if you're interested, talk with me offline. I can meet with you and we can kind of see, if it fits into your portfolio and if you'd like to invest. Let's see. Okay, so no other questions. So Dave, do you have any questions for Mike?
Not at the moment. I think that from my standpoint of running the farm and making sure the trees are growing, I'm secure in what we're doing. You interfacing with some of the investors probably have a little bit more, but I really do. I really do want to hear about the outcome of the IRS credits for carbon, which would be for international.
That makes two of us, Dave. That makes
When do you think that'll happen, Mike? Any idea when you'll have more clarity on that?
So the most likely way is things tend to get caught up in tax courts for years. I think most likely we'll see the Treasury Department come out with some proposed regulations, probably not until mid next year. But once they come out with that, that'll give us direction. Once they come out with, in quote unquote, proposed regulations, that gives you something you can legally hang your hat on and not have to worry about. So I think we'll see that.
Just to go back, you told me this gentleman put in 1,000 teak trees and claimed an $800,000 deduction.
I don't know how many trees. It was a lot of trees, but no,
Okay,
he had $800,000, not deduction, a credit. He got an $800,000 tax credit given to him. Yeah, it was a lot of trees. It was in I think it was in Oregon or Washington. It's pretty cool.
Well, you have a name? I'll go look it up.
I wouldn't know that off the top of my head, but I can get that to you, and I have your email.
I'd love to read about it.
Send that to you. All right.
So Deb's saying, is it possible to get cash projection pro forma and the K1 schedule pro forma for how many number of years to analyze the investment to share with the CPA to see if it fits with what he's looking for? Oops.
I will share with David Kafka and David Santilla we added a couple columns to your pro forma spreadsheet that shows our tax calculations. I'll send that to you guys, and you probably want to pretty it up before you send it out. It's just in very technical tax views right now, but I'm sending that to you guys now.
Yeah, sounds good. And then once Dave looks at it, Dev and I look at it, then we'll send it to you.
Yeah, I
to
think the
look
answer
at.
is for any actual investor, they're welcome to any information we have, and we will send it out, or any
Yeah.
truly qualified perspective that David's gone through.
Yeah, yeah. And so we're also, just to let everybody know, Dev knows, we are doing another farm tour, the 30th of November to, I believe it's the 3rd of December. So the team pretty much has the back end almost done, if it's not done already. And you can sign up that way, and then, we'll be having that tour, and then we should be starting the harvesting around that time as well. Correct, Dave?
Yeah, it'll probably start just after that. It usually starts at the end of December, but there'll be large pods on the tree, but they won't quite be ripe yet. So there might be a few that we can taste and test, but we won't be actively harvesting until 2 to 3 weeks after that, most likely.
Very
But you
good.
never know. Agriculture is always dependent on the weather. It depends on how
Yeah.
much rain and how much sun we have.
Yes.
David, I know you said this isn't like an infomercial for the Finca, but I do have some questions after looking at some of these projections, if I can ask David Santilli.
Sure, of course.
Why is it why is it that the fair value of these cocoa trees, why is it that they grow so much so quickly? Why are they able to command such a high price for mature trees compared to 1-year trees?
So what happens is with cacao trees or cocoa trees, whatever you want to call them, anything but chocolate trees, please.
Cacao. Okay.
So they take 4 years to start production, and at year 5 they're mature. So unlike a hardwood tree that there's really no value in it until at least year 15, when it gets a large enough diameter to cut it down. But truly you don't want to cut it down to like year 23 to 25. Cacao trees start producing the fruit in full production at year 5. So by year 5 they are mature and producing as fully as they're going to, right? It might vary from year to year a little bit, but it's unlike hardwood. It doesn't take 23, 25 years until they get to a commercially viable size.
So for my analytical CPA myopic brain, year 1, I've got this tree, but I can't get any revenue out of it. So I have to keep investing money to grow it, to nurture it for 5 years before it spins out. But once it's in year 5, people would actually buy that tree if you wanted to sell it, right?
Well, you can't really transplant them, but yeah, I mean, if you were thinking about a marketable asset, yes. If you tried to sell me a 1-year-old cacao tree, I might give you $20 for it. If you tried to sell me a 5-year-old cacao tree, I might give you $1,000 for it because I know it's producing, right? And I know it's got a viable lifespan of 20 to 25 more years. So it's the first 3 to 4 years that the trees need a lot of attention and upkeep and maintenance, and thereafter they do it, well, we call it canopying, where they grow together and they form a canopy so that the maintenance of weed control is much less, and they just kind of become self-sustaining. Self-sustaining is not right. They still have to be pruned, they have to be cared for, but there's a lot less work that goes into it once they're 5 years old than the first 4 years.
That's amazing. That's appreciation. Yes, David Kafka. That's an appreciating asset.
Yeah, and it tastes so good too. So it's even when it doesn't matter, who's in president or what virus is out there, them trees are still gonna grow. So
And chocolate's always going to be good.
Yep. If you look at what never goes down in a downturn, it's alcohol and chocolate. So I think we're good. We have one of the two. So man. So I mean we're kind of top at the hour. So we just like to thank everyone for attending this month's edition of All Access Belize. Again, I apologize for the technical difficulties I had earlier. But Mike, I totally appreciate you coming on. Again, if you're not happy with your tax professional, I urge you to please reach out with Mike and his team. They're great people. You'll kind of see firsthand once you get your K1s, how speedy they're going to be and things like that, as long as I get them the material they need in a timely manner. So definitely reach out if you have any questions. Any final comments, gentlemen?
No, I appreciate the time. Thanks for putting this together, Dave. And if anyone has any additional questions, please reach out to David. We're happy to send you answers to whatever you do have and come up with in the future.
Yep. Thank you, gentlemen. Have a good evening. And guys, stay tuned for the next All Access Belize. I'm not sure if we have it. Serena sent you the link to sign up. I think we're working on next month. We're working on the EQRP. So you can see how you can take your 401k that's not active and roll it over into a self-directed type 401k, an EQRP, what the differences are, and then how you can invest passively or actively with that. So stay tuned for that. Gentlemen, thank you very much. Have a good night. Mike, go get a little bit of sleep before the baby wakes up.
I already hear him crying. It's not going to happen. But good night, y'all.
Night all.
Yeah.
All right, everyone. Good night.
Good night.
Night.